There are certain things that are keeping retirees up at night, and long term care expenses certainly are one of them. The idea of having to pay a significant amount of your wealth to a long term care facility is becoming more and more daunting. And one thing that it oftentimes will cause retirees the problem of is not even so much the idea of having to spend all this money, but the fact that they can't utilize the money that they've saved and actually enjoy that money. Now, perhaps you're one of the fortunate few that actually have long term care insurance. Typically, that insurance will cover some portion of long term care expenses. But in the event that you don't have long term care insurance, or if your current policy won't cover the full amount, you can look at some other opportunities. Two of the biggest problems that retirees also face when it comes to long term care insurance are number one, I'm not sure if I'm actually going to need to allocate for this or not. You simply may not know, especially the younger that you are in retirement. The second one would be how much will it actually cost? And will I need to earmark a certain amount of my funds to make sure that I pay for this? Well, that's part of retirement planning is we don't know these answers, but what we can do is plan accordingly and make sure that we have contingencies in place. Now, we covered in a previous video how you can use home equity to serve as a quasi long term care policy. So make sure that you check that out at the end when I link to it. But what if there's another way that you can look to pay if using your home equity is not an option? What you can look to do instead is see if there's a tax efficient way in which you can pay for long term care insurance. And that's essentially creating a separate bucket of money or a separate account and utilizing some of your pre tax IRA to have as an earmarked amount for long term care. In order for this to properly work, you need to actually have assets in which you can pull from. So if Social Security and or a pension and or working part-time are not providing enough income, and let's say you need to draw on your current investment account to supplement some of that income, this could complicate things a little bit. But if you're currently in a situation where you've accumulated assets and the amount that you're withdrawing from your accounts is well within the range of not running out of money, then you can consider an alternative strategy and utilizing some of the assets that you have to serve as another type of quasi long term care insurance policy. The level of care and how much you actually want to earmark are where this can actually come into play. If you really are concerned and you want to leave a larger amount of money, perhaps let's say 2 years of care at the highest potential level for you, let's say it's $150,000 a year, you're going to utilize that $300,000. But if you back out other income that you'd be bringing in, let's say, for example, Social Security, if that amount was $50,000 a year that you'd be bringing in from Social Security, then perhaps you can take off $100,000, being that that would cut into it. So in this case, you would have $200,000 earmarked in the event that Social Security and the amount that you've saved would help cover what those expenses would be. Now, another question that a lot of people would say is, well, how exactly should I be investing this? And this is going to depend on a couple factors. Most commonly, it's how anybody should be investing money and the factors that they should be considering. The first would be your time horizon. The older that you are, the more likely that you could be facing a long term care need. Therefore, you would want to make sure that you're not invested too aggressively in the event of a sudden market downturn. And in that case, you could lose some of the funds that you'd be relying on for long term care. However, if you're just starting retirement or even a couple of years away, perhaps in your early 60s or even mid 60s, most long term care needs don't take place until later 70s, 80s, and even into the 90s. Therefore, you have time on your side. Perhaps it's worth being a little bit more aggressive and focusing on growth inside this account. Keep in mind that if you're 15, 20 to 25 years away from a long term care need, those expenses are likely going to go up as well. So you want to make sure that your time horizon and your risk tolerance match up with that. One of the things that we would want to be considering from a tax standpoint is how you would want to invest this and where you wouldn't be investing this from. I think a pretty solid argument can be made that it would be smart to look to invest this from a pre-tax account. And here's why. Since pre-tax accounts are going to be taxable on the withdrawal, you should note that anytime that you take a withdrawal from these accounts, it's going to be added to your taxable income. However, one of the things that you can look to do if you have a long-term care expense is to deduct these medical expenses that would incur over 7.5% of your AGI. So let's say we have an individual who has an $85,000 care need in a given year. That $85,000 would be the total medical expense that he would incur. He would take an $85,000 IRA withdrawal to match up and to pay for this. If the annual adjusted gross income at that point would then be $150,000 from other sources, let's say it'd be Social Security or a pension, that being the case, we would find that the threshold, 7.5% of the AGI, would be $11,250. The total deductible amount, though, would be anything in excess of 7.5% of that amount. Therefore, $73,750 could be deductible, thus wiping away a significant amount of the taxable IRA withdrawal that they'd be taking out. So the tax savings that we're seeing from the $85,000 withdrawal and the $73,750 deduction can actually be in excess of $16,000 if this individual was in the 22% tax bracket. Now, the higher the cost is or the higher marginal bracket that you would be in, the more the savings can be. But where this can actually come into play is if you have a surviving spouse or children that you're planning to leave the money to. In the event you leave a sizable IRA to a spouse, they could have a number of different expenses that they would incur if too much of a pre-tax account would be left to them. We made a video on the widow's penalty and how that can affect a surviving spouse. But one of the things that can end up leaving for the spouse, if too large of a pre-tax account is left, is that their RMD could then add up and put them into a higher tax bracket, being that they would be collecting from the single bracket and not the married filing jointly bracket. The way that this can be done is actually pretty simple. What you can do is, if you have a large pre-tax account, is split off and transfer an amount into a separate IRA. If you do an IRA transfer, that amount would not be subject to tax in the year that you do it. So again, let's say that you have a pre-tax account of $1 million and you want to set aside $200,000. You're able to keep $800,000 inside the pre-tax IRA that you currently have, and then transfer the $200,000 to a separate IRA that you're able to earmark for such purposes. Now, the $200,000 would still have the same required minimum distribution schedule as it would have when it was in the $1 million IRA. So you want to make sure that you're taking out your RMDs properly. The thing that it would create is an extra RMD, or you would have to aggregate your RMDs from the first account that we had mentioned. But what you can also make sure of is that that $200,000 is invested based on what your strategy does require. But some of the other benefits that you can consider with this are the fact that you are then able to psychologically understand that you have a plan for long-term care in the event something does happen. The other thing is, if you don't actually utilize this for a long-term care need, that can be part of a potential legacy play. Or you may find later in life that you're not going to have long-term care needs and you could spend this a little bit more liberally. I would caution that strategy because, again, you just sometimes never know. But this could be something where you're not bound by this strategy even later on in retirement. I opened the video by saying that this strategy isn't necessarily for everybody. And this does typically work best if you fit under a couple different criteria. And those criteria are that you have a significant IRA balance. Being that you're not relying on significant income from your IRA balance, this could be something that would be worth considering for you. The second thing that would be that you plan on self-insuring, not actually paying for long-term care insurance. Also, if you're looking for a strategy that focuses on tax efficiency, this could make sense for you. And speaking of tax efficiency, one thing that we've done is we've created a quiz that you can fill out. And if you complete it, we'll give you a personalized video on some things that you can consider when it comes to making sure that you're making the most out of your retirement planning and the tax planning inside your retirement plan. What I think we want to keep in mind is there's no one best way to pay for a long-term care need. The best way to do it would be to avoid it altogether. In the event that you can't avoid it, there are different strategies you can consider. Utilizing a portion of your IRA to help pay for this can be one strategy among several. Something else that you can consider is utilizing home equity to pay for a long-term care need. And you can check that out by clicking in this video right here. When it comes to tax planning in retirement, there's been a lot of talk of Social Security benefits and the taxability of that. To find out if your Social Security will be taxable in retirement, you can check out this video right here.